Today's session is probably the most important of all the sessions we do because we're going to talk about financial aid. So we're going to go through the different parts of financial aid, the formulas, the applications. We're going to go through need-based financial aid, and we're going to go through the merit-based aid. And really what we want to help people determine is what should you focus on in this process? And that's very different depending on how your family socioeconomics are, as well as the talent level of your student. When we begin to talk about financial aid, it's hard to have that conversation without scholarships coming into the mix. When Sallie Mae does a study every year of how families are paying for college, they really find that it breaks into three categories. Number one, they look at the scholarships and grants that are awarded, which is roughly about a third. And then they also look at the family resources, which can be from assets they've accumulated or from cash flow as they go. And then third, that we'll talk about in a future session, is the student loan component, which is just a part of the equation now. So what this slide is intended to demonstrate is where you should focus your time and energy. When we look at scholarships though, what they found was of the 31% of college that it pays for a family, 86% of the scholarship and grant money that's out there is awarded from the institutions themselves. So I'm not trying to discourage you from applying for private scholarship, but when we look at where to focus, really the institutions are the ones that have all the money. So the last piece on the scholarship slide is really to talk about the athletic scholarship piece. When we look at how many student athletes from high school actually go on to play in college, it's less than 1/3 of 1%. And those that actually get a penny of scholarship money is minute, much less than 1%. So you may have the superstar athlete, but keep your expectations realistic when it comes to college. So how does this whole financial aid process work? Well, there's actually a fairly simple formula for need-based financial aid. Essentially, what it looks at is what is the cost of attendance? So what is the cost to go to that college for 1 year? So that's all in, room, board, tuition, books, everything, all in. And then they're going to take what's called your expected family contribution. And we'll go through exactly how we calculate that in a second. So if you take the cost of attendance minus your expected family contribution, that's going to give you your financial need at that institution. So you see on the slide, there's a couple of quick examples. So if the cost of the university was $50,000 and your expected family contribution was $20,000, well then you'd be eligible for $30,000 of need-based financial aid at that institution. Same family, same $20,000 expected family contribution, but if a school only costs $20,000 and your EFC is $20,000, then you qualify for zero need-based financial aid. So what I want you to take away from this is that never rule a school out based on its top-line price, because the reality is we've sent students to schools like Northwestern and MIT for less than they would have went to some of our state schools here in Ohio, just based on the financial circumstances of that family. A couple other points I like to bring up is that it is an expected family contribution. So a lot of families we work with tend to have multiple students in school at the same time. And it looks like a huge challenge for them, but actually it can create an opportunity. Because if your EFC is $20,000, and let's say you've got 2 kids in school at the same time, well, it's only $10,000 for each of those students. So your eligibility for need-based financial aid can actually go up significantly for those students. One of the things that we encourage people to do is know before you go. You'll see this in a lot of our material. And with it, knowing what kind of financial aid you can anticipate is critical. A few years ago, they started to require that all colleges and universities have what's called a net cost calculator on their website. And those net cost calculators, you go on the website, you put in some basic financial information about your income and your assets, and a little bit of information about your student, and they'll spit out, here's your net cost to go to our school. So that's a really important thing to begin to do, even if you've got a 6th, 7th, 8th grader, so you can at least have an idea of what your financial aid may look like. There's also some great tools to get an EFC estimate, where again, you just plug in some basic information, figure out what those look like. Some of my favorite calculators are on thinaid.org, collegeboard.org, and there are a number of them out there to help you figure out what your expected family contribution might be. Now let me go into exactly how they come up with your expected family contribution and demystify this process for you. The FAFSA, the free application for federal student aid. It's an important part of the financial aid equation, because what it drives is what they call the federal formula. And essentially that federal formula is you feeding all of your financial information into the system, and they're going to give you your expected family contribution. Now the first response I usually get when people do their calculation is, do they mean that every single year? And the answer is yes. You need to file the FAFSA every year. But the most important year is entering into that freshman year. So what schools have is what's called a priority filing deadline. And that priority filing deadline essentially says anybody that puts their information in before this deadline is going to be at the front of the line for any need-based financial aid that may be available at the school. In the January of the senior year, you want to make sure you file that no later than January 15th. And I say that because priority filing deadlines are as early as February 1st. So if you want to be first in line for financial aid, make sure you have it submitted by the 15th. Now, your taxes will not be done, and that's totally expected by the FAFSA folks. So what I typically recommend is that you use your last year's tax return and you plug in that information, assuming it hasn't changed too dramatically. And then also you need to calculate all your assets and all those things as well. So what I want to go into next is the four components that really drive about 95% of the EFC. There's other things like your family size and number of dependents and a variety of things, but really the four things that drive it are the student's income and the student's assets, and the parent's income and the parent's assets. Those four things drive it. So let's look at assets for a second. How do they look at assets? Let's start with the student. When they look at the student, essentially whatever is in the student's name is assessed at 20%. So let's say that the student had a $10,000 account in their name. Well, that would be $2,000 of expected family contribution from that pot of money each year while they're in school. One of the things that I see often is that grandparents with good intentions have set up a custodial account, usually called an UTMA or an UGMA. And those types of accounts are, the custodian is grandpa and grandma, but they are actually considered an asset of that student. So if there was, say, $30,000 in there, that would be a $6,000 each year they'd be expected to contribute. So just be careful about how grandpa and grandma position things if you're a financial aid candidate. Next piece I want to talk about is the parents' assets. And parents work a little bit differently in that they have what's called an asset protection allowance. So there's an amount of money based on the age of the oldest parent that you're allowed to have in assessable assets. So typically, I'll give you an example for a couple that's age 45, that's married, they'd have about a $30,000 asset protection allowance. So let's say, for example, a family had $130,000 of assessable assets and they had a $30,000 protection allowance. The amount that they would assess is that $100,000. And the rate that they assess that at is 5.6%. So if you look at this next slide, it's going to walk you through exactly what is and what isn't assessable. So one of the things that you'll notice is that basically anything retirement is off the table. So your 401ks, your pension plans, IRAs, none of that is considered in this equation. You could have $10 million in retirement plans and it would not affect your financial aid. But some of the other pieces that are in there are things like the 529, mutual funds, cash, all those types of things. One thing that I always bring up is that the FAFSA is looking for 529 college savings plans in any of the children's name that are in your household. So let's say you had 3 kids and each one of them had $25,000 in their 529 plan. What the FAFSA is looking for is $75,000. So they're going to assess all 529s for the entire family. So that's just an important point that I like to point out. One other piece that's on our slide to demonstrate is the Roth IRA. The Roth IRA actually is a very good tool for a lot of reasons. It can be used for college and retirement. So it's predominantly used for retirement and it gives you tax-deferred growth on your money. There is a provision inside of the Roth IRA though that does allow for monies to be taken out for college and not have to pay the 10% penalty. So that's a really nice tool, and it also doesn't show up as an asset. So it actually can be a nice tool to put some money aside into something and not have it show up as an asset. So a couple key takeaways that I like to point out when it relates to this formula with the assets is that it's always better to have an asset in the parent's name than the student's name. They have an asset protection allowance as well as it's assessed at a much lower rate. So what we find though is the biggest driver of most expected family contribution is actually driven from income. So income for students is they're allowed to make up to $6,260 before it counts against them. Anything they make beyond that is assessed at 50%. When we look at the parents, it's actually very different. It's a lot like our tax schedule actually, beginning at 22% and goes up as high as 47%. When parents look at this, the biggest driver usually of the EFC is the parent's income. So we put together what we call an EFC quick reference guide. And essentially what we intend to do is just show you, just based on the adjusted gross income of the parents. This table shows for a family that's married and files jointly on their adjusted gross income. So let's say you make $150,000 and you have 2 children. Well, your expected family contribution just from your income is $33,000 per year, just from your income. So again, the income is the largest driver. I bring this up because oftentimes people hear that, if we reposition our assets, it can dramatically increase our eligibility for financial aid. And that can be true for some families, but what we find is that often the largest driver is income, and there's really not a lot you can do other than quit your job, which I don't encourage people to do. Overall, when we look at the financial aid policies that are out there, what we want to do is just know before you go. So if you are a need-based financial aid candidate, you want to do everything you can to look as poor as possible. And if you are not, I encourage you to stop worrying about need-based financial aid and focus on other things, which we're going to cover, like merit aid and tax aid. So hopefully this has been helpful, and make sure you go and do an EFC calculation and get an idea at least where you stand today.